Welcome, kangaroo travelers, to Traveling Kangaroo. Today, we're hopping into a crucial topic that affects every corner of America: the deep divide between Wall Street's soaring success and Main Street's economic struggles. Stick with me for the next 8 minutes as we unpack the structural fractures shaking the U.S. economy and what this means for you and your wallet. Picture this: the stock market is flirting with record highs, corporate profits are sky-high at nearly $3 trillion, and the wealthiest 0.1% of Americans control more wealth than the bottom 80% combined, a level not seen since the Great Depression. It sounds like a jackpot, right? But here's the kicker. Over 60% of U.S. households are living paycheck to paycheck. Savings rates have plunged, and real incomes are barely growing, or even shrinking in some cases. It's like watching a kangaroo leap high and mighty while the rest of the mob struggles to keep up. This split reality between Wall Street's champagne glow and Main Street's financial pinch is no accident. It's a structural fracture in our economy. Let's hop into the details. Wall Street is riding high on a wave of liquidity, speculation, and algorithmic trading. Margin debt has soared past $900 billion, one of the highest levels ever recorded. Companies are buying back their own shares like kangaroos bounding through the outback, pushing stock prices artificially higher, despite underlying economic weaknesses. Meanwhile, on Main Street, the scene is vastly different. Real disposable income has grown by just 0.5% in the past year, essentially flat. Grocery prices are up 25% since before the pandemic, and nearly 40% of households say a $400 emergency would push them into debt. Credit card interest rates are at a record high of nearly 25%, making borrowing more expensive than ever. This creates a vicious cycle where those relying solely on wages are left behind, while asset owners enjoy historic windfalls. The average American's real income is falling behind what it should be based on long-term trends, by as much as $7,000 to $11,000 per worker annually. What's driving this? Productivity has increased by 70% since 1980, but real wages have only risen 18%. The kangaroo is hopping faster than ever, but carrying less weight for workers. This decoupling is unprecedented and points to a permanent structural shift, rather than just a temporary economic blip. Housing costs have become the biggest pressure point in this story. For decades, the price of a typical home was about 4 times the median household income. Today, it's nearly 7 times as much. Mortgage rates have doubled since 2020, pushing monthly payments to nearly 40% of average household income, far above the long-standing standard banks use to measure affordability. Renters face similar struggles, with rents 25% higher than before the pandemic and vacancy rates at historic lows. Large investment firms have turned housing into a financial product, buying up single-family homes in bulk and driving prices beyond what most people can afford. When shelter costs consume so much of income, families have less to save, invest, or spend on other essentials. It's like trying to hop with a heavy backpack. Eventually, you slow down or collapse. This economic squeeze isn't just about numbers. It's reshaping how Americans feel about their future. Once, nearly 3/4 of people believed their standard of living would improve over the next decade. Now, that number has dropped to just 1 in 4. Young adults are delaying independence. More than 22% aged 25 to 34 still live with their parents, a figure unseen since the 1940s. Retirement worries loom large too, with many Americans doubting they'll ever retire comfortably. The median 401k balance for those nearing retirement is just $88,000, far too little to replace income for more than a couple of years. Why does this matter? Because our economy runs on confidence and expectation, the belief that effort today will pay off tomorrow. When that belief erodes, people save less, spend less, and participate less in financial markets. It's a dangerous feedback loop that can deepen economic fragility. Now let's look at history, specifically the late 1920s before the Great Depression. Back then, wealth was also concentrated in a tiny elite, corporate profits soared, and asset prices inflated beyond reality. The system expanded without solid foundations until it collapsed violently in 1929. The aftermath saw dramatic changes: higher corporate taxes, tighter regulations, and policies that built America's middle class for decades. Today's economic landscape eerily mirrors that period, but with one big difference. Corporate tax rates are at historic lows instead of highs. This low tax environment allows corporate profits to remain artificially healthy, while wages stagnate and wealth concentrates at the top. It inflates asset prices disconnected from real economic strength and leaves most Americans struggling to keep pace. So where does that leave us? The current setup is mathematically unstable. The imbalance between soaring asset prices and stagnant incomes cannot last forever. Economic resets happen when wealth concentration peaks, income growth stalls, and corporate profits run too high relative to the broader economy. When policymakers finally respond by raising corporate taxes or tightening regulations, profit margins will compress, stock prices will adjust downward, and wealth will redistribute, likely not gently. This reset will realign markets with actual economic conditions, but will also be painful for many. For everyday Americans, the Main Street kangaroos, this means preparing for an uncertain future where financial resilience is key. Building savings where possible, managing debt carefully, and staying informed about economic trends can help navigate the rough patches ahead. Before we wrap up this deep dive into America's economic fracture, remember this. Just like kangaroos adapt and thrive in tough environments by staying agile and hopping smartly, we too can prepare for economic challenges by understanding the landscape and making wise financial choices. Thanks for hopping along with me today on Traveling Kangaroo. If you found this video insightful, don't forget to subscribe for more content that helps you navigate the world, both in travel and finance. Follow us on social media for updates and visit travelingkangaroo.com for exclusive articles and resources. Until next time, keep hopping forward, smart and steady.